Hello fellow human, nobody here with a new stock analysis. Today's question will surely make many people happy, but the answer, not so much. Should you buy Micron Technology shares? As always, I will jump straight into my verdict and I will give you my reasons afterward. Ready? Here we go. At today's price of $135, Micron Technology stock is a sell. My price target for 2026 is between $50 and $130 for an average of $90 per share. This means I find the current price completely unjustified, not just for today, but even for 2026. Most investors have been piling on names with the faintest whiff of AI for many months now. Unfortunately, not many seem to be looking at the price tag before they buy. And no, the price tag is not in the share price, it is in the valuation multiples. At the same time, valuation multiples are not the straightforward business you might think. I see plenty of people handing out buy recommendations on the basis that, oh, the PE ratio is just 20. Well, my friend, let me tell you a little secret. Valuation multiples are not equal for everyone. Anyway, cue the disclaimer. If you're watching this, I assume you're not a lemming, but a sovereign individual. Nobody can tell you what to do with your own money. I only provide you the tools to take financial matters into your own hands. You alone are responsible for where you place your time and money and trust. So no, this is not financial advice. This is just how nobody invests. Micron Technology is a leading provider of memory and storage solutions. It develops and manufactures advanced semiconductor devices such as DRAM, NAND, and NOR flash memory, which are used in a very wide range of applications. Micron collaborates with leading technology companies, including major OEMs like Apple, Dell, and HP, to integrate its memory and storage solutions into their products. It also partners with cloud service providers, data center operators, and automotive manufacturers to provide advanced memory solutions tailored to their specific needs. It classifies its activities into 4 business units. The Compute and Networking Business Unit, or CNBU, which develops and supplies high-performance memory and storage solutions for data centers, servers, personal computers, and networking equipment. The Mobile Business Unit, which provides low-power memory and storage products for smartphones, tablets, and other mobile devices. The Embedded Business Unit, or EBU, which delivers specialized memory and storage solutions for automotive systems, industrial applications, consumer electronics, and IoT devices. And the Storage Business Unit, or SBU, which offers solid-state drives and NAND components for enterprise storage, client storage, and data center applications. This is just a little summary of what the company does. There is a large number of types and subtypes of memory that the company works with. Plenty more acronyms, but I will not go into more detail here. As you can see, Micron is deep into some very critical parts of the technologies present in all aspects of modern life. And when it comes to the development of AI, Micron couldn't be left out even if it tried. Therefore, Micron seems to be in a great position to thrive in the coming years. But when we're talking about buying the stock, there are other things we need to consider. Let's begin with the company's past growth. As you can immediately appreciate, this is a highly cyclical business with revenue and earnings that fluctuate a lot. Using the usual compound annual growth formula would be a mistake, as we would get wildly different growth rates depending on the starting and ending years. But we can perform a linear regression to see what the trend is. Between 2013 and 2023, this trend points to a 7% annual growth for revenue. On the other hand, earnings have truly been all over the place, and we can, at best, say that they've been flat. Overall, I'm not impressed. This is a modest sales growth and a questionable improvement in profitability over time. Let's see if the onset of the AI age is expected to change this. For the coming 3 years, analysts expect the company to achieve a revenue average annual growth of 41.3% and a gigantic surge in earnings. Well, I guess this settles it then. Micron was previously only waiting for the right time to strike, and it has now become a monster growth company thanks to the development of AI. Because apparently, this is where many people stop looking. As I'm sure you noticed, revenue took a nosedive and earnings have been negative, which is inflating the forward growth estimates. In other words, future numbers look impressive only because the recent ones are shit. No, Micron is not growing its revenue at 41% per year. It is regaining its 2022 peak and adding 42% on top across 3 years. This means a revenue growth of 9.2% per year. Starting to look a tiny bit different, isn't it? And earnings, they are simply going back up to a peak similar to the one reached in 2018. Again, in 3 years. The trend will continue to look flat for earnings. But hey, maybe the share price already reflects all of this, right? Of course, it doesn't. Valuation multiples are much higher today than they've been on average for the past 20 years. And don't be fooled by the average P ratio of 22. It is highly distorted by the times earnings were close to zero, which resulted in several short periods of sky-high PE ratios. A more realistic average P ratio, counting only the normal profitable times, would be around 12. And regarding the PEG ratio, it is only so low because the company is coming back up from the bottom of the cycle. So it is a terrible indicator for a cyclical company like Micron. You might be wondering, how can I consider these multiples high? As I said in the beginning, valuation multiples are not equal for everyone. In Micron's case, it deserves lower multiples for two main reasons. First, Micron's margins are not particularly high, with a gross margin that hits 45% in the very best of years, and a net income margin that goes negative when the market gets oversupplied and the company needs to sell its products at a huge discount. The low margins reflect three key weaknesses of this company: competition, competition, and competition. Most of its products are either commodities or at risk of becoming commodities. The second reason for the low multiples is that as a highly cyclical company, investors see it as a much riskier, less reliable investment. It's just not as nice as putting your money in a company that is predictably growing year after year. So, the stock is very expensive, even for the fundamentals the company is supposed to reach in 3 years. Completely unsurprising, considering that the stock has returned 15.3% per year in the last 10 years. And just in the last year, the share price has gone up by 110%. As we have seen, the company has most definitely not grown this much in the past 10 years. And the expectations for the future are not that impressive either. People are either ignoring how modest the long-term growth of the company has been, or they believe that the company will somehow stop being cyclical and surpass expectations like no company has ever done before. Me, I'm a simple nobody. Where evidence leads, I follow. Not sure wild speculation is wise when it comes to investing. If I'm going to ignore the numbers, I might as well invest in tulips. To sum up, the stock is most likely going to come crashing down sooner rather than later, back to its usual valuation multiples. I hope I'm wrong. Nah, not really. If you found this video only mildly upsetting, please like it and subscribe to the channel for more. Share your thoughts in the comment section and let me know which stocks and concepts you would like me to explore in the future. If you have any questions, just ask. And until the next one, remember, if nobody invests, so should you.